Hello and welcome to yet another instalment of our Nucleus Wealth Insights series. Just a quick reminder that the following presentation is general information only and does not take into account your personal circumstances. Whilst Nucleus Wealth aims to present informing and sometimes entertaining content, please consult your investment professional, financial advisor, or better yet, speak to us before making any decisions based on any of the themes discussed in today's presentation. Hello and welcome to this week's instalment of Nucleus Investment Insights. We have another special guest this week in Philip Soos, who's an independent economist and PhD candidate investigating bank crime and mortgage control fraud. In today's interview, we discuss some of the finer details from the Royal Commission into the misconduct into banking, superannuation and the financial services industry, with a special focus on some of the startling revelations that transpired about our bank's mortgage lending behaviour. In doing his PhD in bank crime and mortgage control fraud, Phil sits in the perfect position to provide some serious insight into a major component of the Australian economy. After the interview, we then look at some of the wider investment implications that these themes can impact in how we invest money every day at Nucleus Wealth. So join Nucleus Wealth's Head of Investments, Damien Klassen, our Chief Economist, Leith Van Onselen, and myself, as we learn more about the real impacts that banks are having on everyday Australians' lives, what looms in their future, and the future of the Australian property market. I hope you enjoy. Today on the podcast, we have an independent economist, PhD candidate investigating bank crime and mortgage control fraud, and the co-author of the book Bubble Economics, Australian Land Speculation from 1830 to 2013 with Paul Egan. Philip Soos, welcome to Nucleus Investment Insights.
Great to be here.
So just to get us, to get the ball rolling, Phil, bank control fraud, that's quite an interesting topic to do a PhD on. So if you'd like, maybe just give a bit of background to that for our listeners.
Sure. I've been long interested in all things real estate and finance. And several years ago, one particular economist from the United States just kept popping up all over the internet, social media and so on. And that was an economist by the name of Bill Black. And he used to be a regulator for the bank board overseeing the savings and loan thrifts back in the United States. And he's written extensively about bank crime. And with all of his investigations, including having cleaned up the S&L frauds of the late 80s, early 90s, he created the notion of what's called control fraud. Basically, it's fraud that differs from street level fraud, which is very simple and it's easy to identify the victim and the perpetrator. And that differs to control fraud, which tends to be institutionalized, widespread fraud that's committed by the controllers of the firms, in this case, the executives and the managers.
Okay, yeah, sure.
And that helps to explain why, even though in what's called the neoliberal period from the 1980s onwards, we've been told that deregulation and privatization of the financial services industry was supposed to make capital markets more efficient. And yet what we've seen is the exact opposite. We've just seen an incredible runaway in fraud all throughout the financial services industry. And it's his work that I've latched onto to help try and explain what's been happening in Australia. As we're seeing, journalists every week they uncover some new fraud, and the gravy train of deceit and criminality just keeps on rolling on.
Okay, yeah, fantastic, and I guess quite timely given the recent Royal Commission into some of the misdemeanours of the bank. So maybe we turn our attention to that now. So obviously there has been some startling revelations regarding the bank's mortgage lending, which I guess is a pretty hot topic for yourself and the work that you've been doing in your PhD. Do you think these are isolated incidents, or do you think there's something systemic going on?
It's definitely systemic. The thing about it is that the earliest instances of fraud that we know of go back to the 1980s with the foreign currency loan frauds. And it just blew out throughout the 90s, except regulators, mainstream neoclassical economists, regulators, they just turned a blind eye to it. Yet if you dig around, you'll find that people have covered it, they've written extensively about it. And it's just one long, filthy sewer of criminality that's just gushing out of the financial services industry. But it really took until the GFC hit for people to take it seriously. And obviously we have the case of the United States where the criminality was so extreme it just couldn't be ignored by the vested interests. And combined with all the fine work that we've seen journalists undertake by uncovering fraud, including some brave whistleblowers. For instance, we've seen Jeff Morris and Adele Ferguson, who have done a fantastic job in unveiling the criminality in the Commonwealth Bank. But that extends across the whole board, and it's just not banks, it's, as we know, insurers as well, non-bank lenders and so on. And we can't say that these are isolated incidents, especially as the Royal Commission from the very get-go in February has just revealed this sewer. And just recently, a week or two ago, it was Clearview Insurance. Mm-hmm. They were revealed to have committed 303,000 criminal acts over a 3-year period, just out of one insurer, and that's just across the board. We'll find more and more.
Okay, yeah, sure.
The real question, and I guess I'm coming at this from an investor's perspective, and I don't want to sort of sound disheartened by it, but I'm on board with the whole this shouldn't be right, and people need to go to jail and to actually make a difference, because if an executive does something wrong and the shareholders get fined for it and the executive goes on to his next job, then he hasn't really been affected by it. And that seems to be the modus operandi at the moment, is that the companies get a decent sized fine. Sometimes it's large enough, sometimes it's not. But generally speaking, people aren't going to jail, and so the behaviours keep on occurring. And arguably in the US, that's sort of what's been happening as well. Is that that yes, it's been uncovered, but you haven't seen a whole bunch of people go to jail on it. And so the question is, if that doesn't change, it seems to me that from an investment perspective, you get a bit of a lull where everyone takes a step back and all that type of stuff, and then the next generation comes through, and everyone forgets that 5 years ago we had a Royal Commission, and the whole process starts again.
Oh, I quite agree with that, because it's a form of moral hazard. Because if the regulators and the justice departments don't prosecute those who make the decisions, which are the executives and the managers, the same criminality will just keep on occurring, even if you have a lull every now and then as industry backs off momentarily. That said, shareholders also benefit from the fraud, because that's the banks are making the profits from it. And of course, a lot of that goes straight to shareholders in higher stock prices, the big fat dividends the banks have been pumping out for decades. And so what we know from the very pitiful fines that the regulators, ASIC in particular, have been levying against the financial services industry is that the fines are just a fraction of the profits that have been made. And so that's why shareholders and the board of directors have pretty much turned a blind eye to all this, because they're the ones benefiting as well. Yeah. It only comes to a point where the criminality is so extreme, as in the case of subprime mortgage fraud, that criminality has adverse effects for financial stability. And then, as we see in the United States, where the banks collapse, then the shareholders lose out, and that's when they begin to care. But by then, it's too late to do anything. Mm.
Yeah, so I guess what it's saying is, so we've almost, in a way, we've outsourced to say, if we just keep finding these companies, then the shareholders will pay attention, and they'll finally get rid of the management, and that'll fix everything. And what's happening is that's not the case, because shareholders are benefiting so much from it that the slap on the wrist is like, oh, well, there's a bit of a fine, but we're still making so much money. Mm. And as you said, the time when shareholders have to worry is actually a systemic problem, not an individual company issue in terms of fraud. So I guess it's from an investment perspective, the cynic sort of says, well, some of these things, you've got to wait a period of time for that to fade off, and you get all these things, but unless we see changes to, unless we actually do see changes, as you said, it seems like we're back on the same path again. And you had an example of Westpac, one of those ones when you're talking about the record fine for assessing home loans.
Yeah, that's right. It was revealed in the media that Westpac and ASIC had settled the day before they were due to go to the federal court over ASIC's allegation that Westpac had failed to perform due diligence for approximately 10,500 home loans between 2011 and 2015, because ASIC alleged that Westpac had committed violations of the National Consumer Credit Protection Act, which stipulates that banks must make reasonable efforts to inquire about borrowers' true expenses rather than just applying a standard measure, which is the household expenditures measure at the HEM. But it turned out it was possible that Westpac had failed to perform due diligence for about 100,000 loans.
Wow.
And if you read through the NCCP, you'll see that each civil violation carries a maximum penalty of 2,000 units. And each unit is currently $195. And it also turns out that if the civil violation was committed by a corporation and not an individual, then a maximal multiplier of 5 times can also apply. And now ASIC settled for $35 million. But if you look at what the maximum fine could have been, which is 100,000 times 2,000 times $195 times a multiplier of 5, that adds up to $210 billion.
Wow. Yep.
That would have just collapsed Westpac there and there. But amazingly, ASIC, with their public relations propaganda, they came out saying, oh, this is a fantastic result for consumers. $35 million, that's a huge fine. But if you look at it, that was only 1/1/6000th of the potential maximal fine.
But it gets what, $350 per customer? Have I got those zeros right on that? So it sounds like basically that's less than the commission you pay to a broker to bring in the deal.
Yeah, I know it's a tragedy, but it gets even worse because the judge who was to okay the settlement, Justice Perham, he looked at the case and said, well, what evidence do you have that Westpac has actually committed these civil infractions? And so he hasn't yet okayed the $35 million fine. So it could turn out that consumers and taxpayers get nothing at all.
Wow, that's unbelievable, isn't it? Yeah.
It also sounds as well, like I said, $350 a customer. I would think a lot of banks would actually say, you know what, if I can fraudulently give these loans and it costs me $350 to sort of pay off the regulator, so to speak, to let it go through. That's as I said, much lower than what they're paying mortgage brokers. So.
Oh, absolutely. But it gets even worse than that because, as the excellent American journalist Matt Taibbi has written, especially in his book The Divide, looking at the different treatment of elites compared to the common person in the street, he notes that the fines for the banks are actually an anti-deterrence measure because the sociopaths in the corporate boardrooms now have a price they can incorporate into their cost-benefit analysis for committing future criminality. And as we're seeing in Australia, including the United States and other places like Britain, that price, that fine is tiny. It's usually just a fraction of the profits. And as Michael Yander, the ABC journalist, pointed out, the profits made on the 10,500 home loans, that $35 million was only about 30% of the profits they would have potentially made.
Wow. Yeah. So it's just essentially the cost of doing business.
Oh, very much so. Yeah. And managers, they benefit because the more criminality they commit, the more revenue, the more profit they make. And shareholders also benefit from higher stock prices, fatter dividends, and so on, until it gets to the point where it has implications for financial stability in our $1.7 trillion mortgage market. Then it becomes a big problem for shareholders.
And do you think that? Well, I guess obviously this has come back onto the bank, But who do you think is to blame here? Is it the banks for allowing it, or is it the brokers for facilitating? Because isn't it about 1 in 2 mortgages that are originated through a broking channel of some description? So obviously there's a guy there that's commercially, incentivized to potentially help a sale or help a loan come through. But is that your view, or is it sort of what would be your thoughts? I'd be interested to know.
Well, my views are formed by the research performed by Australia's leading financial consumer activist, Denise Brayley, who's been dealing with mortgage fraud and all sorts of other criminality over the last 2 decades. And it turns out that there's been significant growth in the broker network over the last couple of decades. And the reason for this is because the banks are essentially creating 6 degrees of separation. And they're using brokers as a bullet shield, you could say, where the more and more loans they try to originate through the broker network, the greater the shield they can protect themselves with. And the way it works is that the banks, they claim, in fact, they lie all the time about this. They claim that the broker is the agent of the borrower, not the lender.
Right.
And that means, allegedly, that the broker, the borrower has legal liability for anything that the broker does. But that's not the case at all. Legally, and also in determinations made by the financial ombudsman, the broker has always been, and including other intermediaries, has always been the agent of the lender, which means that the banks have legal responsibility for anything the brokers do. And so if brokers fudge details such as lowering borrower expenses and inflating income and asset data, that's actually not the borrower's fault, it's the bank's fault. But the banks, they lie about this to the ombudsman, to the regulators, even in Parliament, and everyone buys their argument. But even as early as 2002, the former head of the financial ombudsman back then, that was Colin Neve, who's now with the Commonwealth Bank, he made a determination that financial intermediaries, including brokers, were actually the agents of the lenders. So that any liability for any dodgy stuff is the fault of the lenders.
Yeah, so when you're talking as a shield, though, I guess it's most of the brokers don't have any capital behind them anyway. They're basically, you get paid what you get paid, and you take it home, and you own a computer and a couple of desks. So if anything goes wrong with the mortgage, it's not like the banks can get anything back from the mortgage from it. What you're saying is that this is more of a legal. It's more of a, if something goes wrong from a regulator's point of view, I can point to this. They know they can't do anything. Well, they get stuff all back if there is a problem with the fraud in terms of taking assets from the broker. I guess that's one part. And so, yeah, so it's more of a regulatory fiction rather than a capital fiction. Is that how you say it?
I quite agree.
Yeah, and that sort of leads on to this issue then with the. I guess there's a two-phase one with the mortgage insurers. So, under your understanding, let's say the housing market takes a bit of a tumble and everything hits the fan and everyone's pointing fingers at everyone else, and the lenders' mortgage insurers are saying, well, you wrote these and they didn't have they didn't conform to the standards we wanted, and so that insurance is null. Who's going to win that battle? Is it going to be the mortgage insurers, or is it going to be the banks that's going to?
It's definitely going to be the LMIs, because if there's any fraud in the application, the LMIs can say, no, we're not going to cover you. This loan was originated on fraudulent pretenses.
Yeah. And
during a downturn, the LMI corporations like QBE and Genworth, they're not even going to be around. Their capitalisation was about 80 basis points at the peak, which infers a leverage ratio of about 125 times their capital.
Wow. So
there's no way that during any kind of downturn where you have a big pickup in the non-performing loan rate, just even a few percent, 4 or 5%, the LMIs will just go straight under. But also, we know that the big banks have also been self-securitizing LMI within their own units. And so during a downturn, their own units won't be able to even cover their own banks' liabilities if the NPL rate picks up. So it's LMI is basically an illusion. During the good times, banks have enough capital to weather a small number of NPLs, so they don't really need LMI.
Sorry, NPLs for those?
No, non-performing loans.
Okay, sure. Yep. No.
Basically, the combination of delinquencies and defaults. But when the shit hits the fan, proverbially, LMI simply don't have the capital to pay out. So either way, there's just no need for LMI. The banks should fully have all the risks on their own books rather than hiving it off to separate insurers.
Yeah, I remember a couple of years ago I looked into this issue. It's probably that the capital numbers would have changed, but like 3 or 4 years ago, I think the LMIs had about $1 billion of capital, and that's on a $1.7 trillion of mortgage loans outstanding, roughly. So it was laughable.
The cynic, though, sitting in the corner here, is saying, "Well, is this just another fig leaf to then go? Well, look, we insured all these mortgages. We tried to do our best. It's fallen over. Government, can you just step in and back these mortgages for us?" Which seems to be sort of what, I guess, vaguely what happened overseas. I guess in terms of depending upon how you pick the market is if everything goes wrong. So the bullish bank investor still says, "Yeah, I understand what you're saying, but the government will step in and sort this out if something goes wrong." Have you got any thoughts on?
Yeah, well, I mean, just on the LMIs are really just a regulatory arbitrage. So the banks undertake lenders' mortgage insurance because it gives them lower capital costs under the Basel Capital Accord. And as Phil said, it's just a fig leaf in order to lower their capital adequacy requirements under APRA's rules. And but that doesn't really have any bite.
Okay. And just a quick one, I guess, just touching on before. So obviously we sort of kicked off on the fact that the GFC brought through widespread banking reform under extreme duress in the US, for example. I guess now just reflecting now on where we're currently at, perhaps in the property cycle, the lending cycle, and the fact that the Royal Commission has brought all of this, to a head, along with, a couple of the journalists you mentioned, probably have been building the case for the Royal Commission just in time for it to drop. So, Phil, what were your thoughts then? What are your thoughts on whether or not are we staring down the barrel of an Aussie GFC, or do you think this is going to help pull us up a bit short before the banks go to a point where it's a sort of a cataclysmic sort of correction like it has been in the where the markets basically created the GFC and the collapse of the banks? Where do you feel that the Royal Commission is, I guess, being a canary in the coal mine for change? And that leads me on to a question about what you expect to see as an outcome for the Royal Commission. So I expect that one afterwards. But your thoughts there?
Well, I had high hopes for the Royal Commission, but unfortunately, Turnbull and the Liberals basically sabotaged the Royal Commission. It gave only 1 year, minimal resources, and the sole commissioner is a staunch Conservative. And under those conditions, I really don't hold out much hope that they'll be able to get through to the very basis of the rot, because the mother of all frauds happens to be in the mortgage market. And one would question if, say, the commissioner for the Royal Commission to Unions was a Marxist, that might turn some heads. But when it's a Conservative overseeing the Bank Royal Commission, it's considered to be perfectly normal. So I would assume there's a bit of bias, but ultimately most people seem to think that Commissioner Hayne is quite competent and independent. But that's not so much the problem as in the limited time span of 1 year. You simply can't uncover the sewer of criminality in the financial services industry in that period of time. For the trade unions, it was a year and a half. And for the Child Abuse Royal Commission, that was almost 5 years. And literally, given all the frauds that have been occurring back to the 80s, we need a minimum half decade to investigate and to give victims a chance to get up on the stand and air their grievances.
Although there has been a bit of talk about extending it, hasn't it? I know that Greens and Labor want it extended, and over recent weeks we've had a few coalition members come out saying that they're amenable to extending the Royal Commission. Do you think it will be, given another 6 months, 12 months?
My money is on probably another 6 months, but even then, they still lack the resources and understanding. So early on, Lindsay, David and I, we had a conference call with the solicitors who advised the QCs at the Royal Commission. And we advised them that, okay, there's a whole lot of frauds, but they're just no bigger than parking tickets relatively compared to the mortgage control fraud. And they really need to use their powers of discovery to get the bank's databases and then give that to, say, an independent second-tier quality auditor in, say, a country where our big four banks have no real power, like the United States. And there the auditor can perform a complete econometric analysis of the databases, also linked it up with borrower data from the ATO to confirm whether that data is sound, and also to draw out a scientific sample to contact borrowers directly to ascertain their true details. And that way you could really tell how much fraud's in the bank's loan books. But they haven't done this. And in fact, as Denise Brayley said, the Royal Commission, they spent about 6 days on loan fraud, and that's it. They just moved off onto the business side and the insurance side of superannuation. And so given a year, it's just so much that the Royal Commission has to look over. They just can't spend enough time to really investigate any single part of our financial services industry in depth.
Okay. Yeah.
There's some argument from ASIC's perspective that they don't prosecute more of these crimes because they don't really have the legal powers to, or the standard the standard of proof is so high that they can't actually follow a lot of this through. Have you got any thoughts on that, and what changes would need to be made so that they couldn't use that argument?
Well, under the best of conditions, every regulator is underfunded. We definitely need more funding, more personnel for our regulators, but even that's a second order problem. The first is that the regulators are just captured. Now, under the ASIC Act, the Trade Practices Act, the Crimes Act, and the NCCP, the regulators have everything they need to prosecute the criminals in the financial services industry for all the control fraud that they've been committing. So our regulations don't really need to change. The laws don't need to change. We've got everything except that ASIC, including APRA, have been captured, and they simply refuse to go the full length to criminally prosecute. So ASIC would rather just stump up some illegal agreement with the banks and other financial firms for a paltry fine, maybe some enforced undertakings, education and training and so on. But these are just cop-outs. And as we know from former lawyers, they used to work with ASIC. There's a lot of good people in ASIC that want to go forward and prosecute the criminals, but the executives at the top, the commissioners, they just don't have the spine for it. And it's little wonder why. For instance, the previous head of ASIC was Greg Medcraft, who came in from Credit Suisse from the United States, and he had a hand in setting up the securitization chains, where a lot of the dodgy CDOs and RMBS were offloaded. And as the US economy was going into meltdown, he lobbied Congress against imposing regulations which could have stemmed some of the worst aspects of the crisis. At that time, Gillard and Swan thought that was a perfect candidate to put as a head of our financial regulator. And then after Medcraft left, they brought in James Shipton from Goldman Sachs. I mean, this is really, getting the fox to guard the hen house, or asking, Count Dracula to be the head of the blood bank. What do we expect? In fact, as Cameron Murray in his excellent book, The Game of Mates, have pointed out, one way you can disrupt elites and their networks is to bring in outsiders who have no formal connection to local networks. And so when Shipton, when his time is up, it could be a perfect time to bring in someone like Professor William K. Black, the US economist, who's probably the world's leading specialist on bank control fraud, and put him as a head of ASIC, because he has no connection to the networks here, and he's extremely competent and ethical. But of course, that's the last kind of person our government and elites would like to see in.
And do you think if, say, something like that example you've used there was to be enacted, would they then, I just potentially think that they might be frustrated then by the potential lack of resources to do the work they need to do? Do you think it's a resourcing thing alongside, obviously, a guidance thing from the top? Or is it something where you've got to just clean house and throw money, potentially at it to get the job done?
Probably a bit of both. As I said, regulators under the best conditions are always underfunded. There's definitely a case for definitely funding ASIC more, even though I think it was under Abbott and Hockey, they tried to cut 100 million or so from our ASIC's budget.
Wow.
And after an outcry, they restored it. So that shows you how much the coalition really cares about elite fraud. Well, of course, going after all the petty fraudsters on the ground, like welfare cheats and so on. There's a really good analysis of this in Matt Taibbi's book, The Divide, that looks at this, and it's well worth reading.
So, in terms of the actual size of the control fraud, have you had a look at, I guess, what you think the loan market would be without this, in terms of just growth rates, or I guess how much smaller would it be than if you had to account for the systematic abuses?
Well, definitely the $1.7 trillion market would be a lot lower, and consequently house prices would be a lot lower as well. But it's very difficult to tease out these facts empirically without gaining access to the bank's loan books. And in the United States, there's been quite some good research performed by economists in the wake of the implosion caused by the GFC. And the United States has the benefit of the HDMA Act 1975, which is the Home Mortgage Disclosure Act, that obligates financial institutions to make their loan books available to the public. And so you can literally go on the financial consumer website in the United States, and you can, for instance, download JP Morgan's loan book just like that. It's really great to have that kind of data accessible. And what some US economists have done is perform complicated econometric analyses, and literally down to the postcode across time, they can figure out the level of mean and median income overstatement on borrowers' applications. They can also figure out how much that mortgage fraud has contributed to the hyperinflation of prices on the upside, and just as importantly, the hyperdeflation of prices on the downside. And I can do this all the way down to the postcode. But the thing, in Australia, we don't have access to the mortgage books. It's very heavily protected, intellectual property and all. And not even the RBA has complete access to the big four banks' mortgage books, which would be a real win if we could get a hold of it. But it's just not going to happen.
And so how, in the US, sort of in a broad sense, how big was the difference? Are we talking, is it sort of 10%, 30%?
Up to at least 10 to 30%. In fact, around that range.
Right.
But it differed all among lenders. And so the worst of the lot were non-bank subprime lenders who were just issuing out loans to, the so-called ninja loans. No job, no income, no assets. And 2004, 5 and 6 were the most... were the worst years for the fraudulent issuance. And this can be all carefully analysed through econometric analysis, but here we just don't have that opportunity, which is a real pity. But we can go around it. So for instance, in my PhD, I'm using what the control fraud model that Professor Black developed. And in it has 5 elements where you can use to estimate whether a bank at the micro level or the banking sector at the macro level is engaged in mortgage control fraud. And those 5 elements are extreme lending growth, minimal capital buffers, extreme leverage, high executive pay packets, and a collapse in underwriting standards. And for the first 4 elements, we've got all sorts of public data on it, so it's not so much an issue. But the 5th one, collapsing underwriting standards, it's much more difficult to get data on because, of course, the banks don't advertise their criminality. And that's why the work of Denise Braley has been so invaluable, because she's been able to get a lot of the loan documentation from the banks, from the clients she advocates for. And I've seen them myself. I've also dealt with a couple of fraud cases. And when you get the true loan application forms, including what's called the application tracker from the banks, you see all sorts of income and asset inflation. And you also see a strong reduction in expenses. So banks have been using the HEM measure, which averages at around $33,000 for a household, which is a bit of a joke because data from ABS shows that for households that have mortgage debt, their average expenses are around 80 grand a year.
Wow. Yep.
So there's a big difference. But Braley says it gets even worse than the HEM because some banks use the HPI, which is the Henderson Poverty Index, which literally goes down to about 22 grand a year, and you add about 2 grand per child.
Wow. Yep.
And of course, I mean, what kind of household has expenses like that?
I wish.
Expenses like that, and a big mortgage and a big house. Yes.
Oh, exactly. Right. And as that small Westpac database that came out from the Royal Commission, it's showing 420 mortgages. The vast majority had the HEM measure applied. And in fact, in one of Wayne Byers, the head of APRA's, he had a speech a couple of years ago, and he showed about 80% of all loans originated in our banking system have a standard HEM or HPI measure attached to it. So banks have not been investigating or performing due diligence on borrowers' expenses, and there's only one reason for that. So they can put an artificially low estimate so they can lend out as much as possible.
Yeah, well, that makes sense. I guess so. Then, just sort of, I guess we'll look to wrap up in a couple of minutes. But so you've covered off on a couple of, I think, key solutions really facing, in regards to what could potentially be done at ASIC. We've spoken a little bit, obviously, again, about the outcomes from the Royal Commission. It's pretty common knowledge now that we're in a deflating property price, environment, particularly Melbourne and Sydney, which have obviously seen the most rises recently. So that stands to reason. How do you think the outcome of the Royal Commission, if any, and you're probably leaning on the more conservative side of outcomes from the sound of things, how do you think that's going to then parlay into this falling house price? Is it problem or benefit? I think it depends on what side of the coin you're on. But do you think that it's going to be an accelerant, or how much further do you think property prices have got to fall from your understanding?
Well, definitely the Royal Commission put the fear of God into the banks, but only temporarily. So they've been performing much stronger due diligence, asking for all sorts of expenses, going over bank statements and whatnot, looking at incomes, looking at what other debts that borrowers may have. And so that's why, according to Martin North, refinances, rejections of refinancing, it was about 5% a couple of years ago, and now it's reached up to 50%. And so it's quite a crunch. And it's also occurring on the developer and builder side as well, where they're having much more trouble gaining loans for their business. And so many of them are actually turning to non-bank mezzanine finance, which have interest rates up to 18% and above. So it's causing quite a crunch. And interestingly enough, in the AFR yesterday, they came out with an article which was really quite interesting. It alleged that Westpac were sending letters to property investors telling them you've got 1 month to bugger off and go find a new lender because you're too risky. I've never heard of a bank foregoing principal and or interest payments because they thought that the loans were too risky. And somewhere along the line, the risk managers at Westpac must have looked into the loan book and said, and they're just trying to shovel off some of their worst risks. And the thing about it, in the AFR article, I think it was by Duncan Hughes, the Westpac spokesperson denied that they had ever sent out these letters.
Is that right? Wow.
Whereas the property investors, including the journos, had seen the letters. So someone's not telling the truth here, and I'd just like to know, what's happening.
Just on that, which Australian bank do you think's most involved in this kind of malfeasance?
Oh, easily at the top is Commonwealth Bank and Westpac. They've had the largest interest-only proportion, and also the fastest growth of their books. NAB, they're more into lending for small businesses, SMEs, farmers. But even there, as Professor Evan Jones, an economist at Sydney University, has documented over the last couple of decades, there's tons of fraud happening there, and ANZ is somewhere in between.
Macquarie seems to have sort of stayed out of the spotlight very much on this one. I know they got into a lot of trouble a few years ago for sort of a lot of compliance issues internally, and they've now been growing their loan book extremely fast. So I don't know whether you've got any thoughts or sort of, I guess, what you're seeing in terms of, I guess, did they clean up their act, or are they now
taking on the risk?
Why haven't we seen Macquarie? I guess is the interesting thing.
Probably because its loan books were very small to start with, and so that allowed them to rapidly ramp up the growth rate of issuance. But I'm not sure if Denise Braley has ever come across clients who were given loans that were originated from MacBank. But definitely from other things, we know that Macquarie Bank's been engaged in a lot of dodgy stuff, but whether it's mortgage control fraud, I'm not sure about that.
Yeah, well, I mean, just on CBA and Westpac, am I right to say that they account for about half of all bank lending, don't they, to mortgages? Is that about right?
Yeah, Commonwealth Bank is by far and away the largest.
Yep.
But also Westpac, in their lending to investors, has experienced fairly strong growth, including having the highest proportion of interest-only mortgages to investors, which peaked at about 50% of their loan book.
Yeah, and on Macquarie seems to be, as you said, it's going under the radar because they were so small to begin with. But they're also, Macquarie, along with the other big four, is the only bank that can use its own internal models to determine its capital. So it's in this sort of sweet position where it can keep its capital costs really low through its own internal models, but then also escapes under the radar because it was so small to begin with. So I think that's one of the reasons why it's got the opportunity to grow so fast.
Oh, definitely. One of the gifts to the banks during the 2000s was the Basel II Accord, which allowed sufficiently large banks to determine their own capital risk weightings and ratios. And of course, banks immediately gamed this to hold as little capital as possible. And at that time, in the early 2000s, the three of the big four banks were ready for it, but the NAB wasn't. But APRA at the time thought it was embarrassing if the NAB wasn't also given it. So they just made them. They just gave them accreditation. And of course, MacBank also has this as well. And so no doubt this is a benefit to the big four banks plus MacBank relative to the second tier lenders and the smaller ones like the mutuals and the credit unions. And I think that that accreditation should be stripped away.
Mm.
Can I ask you to abandon your ethics for a minute and let's pretend we voted you in as a Prime Minister of Australia with a strong property background, with a lot of mates in property, and there's a Royal Commission going on, so you know the lending's falling back and housing prices are sliding, but you want to make sure you get elected at the next election, and having strong house prices to you seems like the best way of doing that. What's your what are you going to do? And do you think you can, by playing playing with other policies, and which policies would you be choosing, trying to keep the house prices from falling over before the next election?
Well, there are quite a few policies one can do to keep on inflating land prices. One is simply to not extend the Royal Commission. One is to try and rent seek with the regulators to make sure they don't investigate any of the loan fraud. Another one is to ramp up the RBA's committed liquidity facility, which is basically QE for the banks. And as Lindsay David found, looking through the rules of the CLF, the RBA explicitly states they will not investigate the health of any of the securities that are sold into the CLF. So it's basically like a trash dump for the bank's worst RMBS and their CDOs and whatnot, and the ABS just to dump in there in exchange for cash. So that can be expanded. So that's it's basically a form of QE, even though it's not explicitly stated as. You can have obviously another first homeowners grant. That's always a best bang for buck type policy. We saw Howard do it. We saw Rudd do it very successfully. And of course, Morrison, given he's got the background as a director or an executive at the Property Council of Australia, it's quite possible that in the lead up to the election, he'll just ram one through to inflate prices again. At the state level, there can be more stamp duty discounts. There could be more shared equity purchases between governments allegedly helping poorer people to get into housing. Of course, with our gigantic superannuation pool, multi-trillion-dollar pool, more of this can be opened up and to siphon off into the property market. And so there's really a ton of measures that at the federal and the state level that politicians can enact to keep the Ponzi going.
Just offsetting that, what do you think is the likelihood that Labor will follow through on its negative gearing and capital gains tax reforms?
It's probably pretty low because prices are currently falling quite steadily in Sydney and Melbourne. And by the time that Labor gets into power, just say maybe later this year, if there's an earlier election, or if the coalition lasts the full term through to May 2019, prices would have kept falling even more by then. And so it's very unlikely that with the falling prices, plus industry screaming about this already, it's unlikely that Labor will have the spine to go forward and enact their modifications to negative gearing and capital gains tax, even though they are very minor alterations and it only applies to purchasing of the existing stock, whereas it grandfathers all the original purchases.
Okay, very good. Oh, well, on that note, we might finish up. But look, thanks very much for your time today, Phil. I think it was a fantastic session. We got a lot out of it. Now, for people that are wanting to hear more about the work that you're doing, they can head over to Twitter. I think you're at Philip Soos. Is that right?
That's correct.
Yep. And where else? Where else are you? I've seen you in The Guardian. And where else can people find you?
Just around social media.
Okay.
My email's up on the internet for people to contact me.
Yep.
And always happy to entertain these queries.
Excellent. Okay. Well, on that note, well, thanks very much for coming along, and we look forward to having you along again sometime soon. So cheers.
Thank you.
So, Damien, that was a pretty remarkable interview. There was plenty of insight there from Phil. He's certainly a wealth of knowledge in all things banks, and given the Royal Commission, still waiting to see what the outcomes are, and I think we'll find that out tomorrow. Some fascinating insight, as I said, and I guess really, how is that now going to translate into what we do every day at Nucleus Wealth?
Yeah, it's tough to drawing out some of the investment ideas from this, because one of the key issues for this whole banking fraud part is that there's a moral side to it, and as a consumer and a member of society and things like that, the things that should be done, and then there's the question as an investor trying to work out what will be done. And so as we heard, the banks have been doing this for a long time, and they go through these cycles where the hand's in the cookie jar and then it gets caught, and it's like, oh no, I'll never do that again, and slap on the wrist, and then you wait a year or two, and then next thing the hand's back in the cookie jar. And so it's a question about saying, what are the penalties? Are the penalties strict enough? Going to be strict enough that the hand doesn't go back into the cookie jar? I guess what I drew on a stock specific basis out there, confirmation that Westpac and CBA. So if you are concerned about the whole thing, and if you're concerned about the housing market, and we've got our level of concern, but other people have greater and usually less than level of concern. But Westpac and CBA have got the biggest exposures. With sort of reconfirmation of that. Macquarie is the interesting one. As we spoke a little bit about there, it's just that part where they're growing the fastest at the moment. They had a stack of compliance issues a few years back and went through a whole sort of round with APRA and ASIC. And so everyone else is pulling back from the housing market, and especially investors, whereas Macquarie's been growing really quickly. So you'd sort of at face value you'd go, and with a history of compliance issues, you'd say at face value it sounds really dangerous. But the flip side is they've pretty much managed to get through so far without a blow landed on them. And so the question is, are they using? Well, they certainly look like they're using this to grow market share. And the question of doing that as the market's weakening, there's certain issues there, but it's it seems like almost a bit of a binary outcome. They'll either do quite well out of it and pick up all this market share, and everything will sail through, and the housing downturn will be shallowish, and next thing you know, they've taken a step up in terms of where they sit. Or the flip side is it gets deeper faster, and so they either go from a great outcome to a really bad outcome.
Yeah, and I think because I think it was Leith that mentioned as well that they've certainly had a good crack at the investor lending book off a low base, of course, but into a downturn in house prices. I guess there's potential jeopardy there, whilst there is also plenty of opportunity. So does that mean Macquarie's sort of off our radar, I guess, from an investment perspective?
Look, we don't have it at the moment. But it's clear to me. It looks like a bit of a binary outcome. It'll either, if the downturn is lower than people are expecting, and they've used the time in the downturn to grow the market share, then they're going to be in a much stronger position locally. If the downturn's bigger than expected, and if anything else comes out, as a Royal Commission or the Royal Commission takes a harsher line, then they could easily see that this growth has been ill-advised and at exactly the wrong time of the cycle.
Okay, sure.
The bigger issue, so that's sort of stock specific. The bigger issue is that the way we tend to think of the banks is as mega bank. They are all very, very similar in terms of they're all exposed to the same markets. Most of them pulled back all their overseas operations, and so there's not a lot differentiating them. You got a little bit between business lending and consumer lending, but largely they're playing in the same bathwater. And so if the bathwater's getting pretty dirty, they're all they're all sharing it.
Yeah, sure. And I guess, and on that note as well, they've all gone to great pains recently to get rid of other major revenue lines, such as their advice and their insurance. So they're all sort of seems like they're all homogenising back into the one.
Simplifying
housing market.
Yeah, that's right. So the issue, we spoke about the level in terms of controlled fraud, and so what we're talking about here is that if they've grown, if it comes to be, and it does appear certainly that because they've kept their levels, the level of income that they assess people on at these such low levels, and they've allowed applications to come through that probably shouldn't have come through, is it looks like that the loan books are probably somewhere between 10 and 20% higher than what they should be.
Wow. Yep.
And so that's in a way basically a bring forward of revenue, and you've loaded up some customers with loans that are going to take them a lot longer to get through and things like that. So I guess what the idea is, you've brought forward 10 to 20% of your revenue and into your assets, and there's got to be a payback at some stage for that. And so the question is, right now, as you look at the whole banking sector and you say, it does look relatively cheap relative where it's been over the longer term. If this sort of control fraud part gets reversed and you get some quite strict measures in place, and it's not just we'll take a 1 or 2 year hiatus from lending lots, and then once the Royal Commission dust settles down, then we'll get stuck back into it again. If it is some genuine long-term things, then you say, well, if you took 10 or 20% off their loan books, or they take that off their loan growth over the next 5-10 years, then all of a sudden they don't look as cheap. And so the arguments for that sort of go away, and then you run through the negatives in terms of will there be bad debt, an explosion in bad debts at some stage? Will you get all these customers suing banks, lenders, mortgage insurance suing the banks? There's a whole bunch of legal things that could obviously go wrong on that front.
And of course fines, although the example that was given with Westpac, it sounds like they've got a pretty good deal as far as the regulators go with paying fines.
Yeah, so as I said, it sounds, we spoke about the numbers, but the fact that it's less than the commissions they're paying on the sales is quite telling. But the regulators are getting a lot of heat for being in bed with the banks, and maybe you start to see a change in that. I guess morally, you hope so, but the history says that there'll be a lot of quite harsh words spoken, and especially coming into an election. There'll be all this, we're going to be really bad and we're going to really punish these guys and all that type of stuff. The real question will be how much of that then gets watered down once the election's all sort of done and dusted, and the banks are very big donors to both sides, and so
and obviously the Prime Minister of the day was pretty against the Royal Commission to begin with, from memory. So it remains to be seen if he changes his position on that, given the findings, perhaps. Yeah,
that's right, and it's worth noting that it's a sad sort of. It's a sad event that's occurred in terms of the Australian market, but we've spoken about it a number of times in that most levels of government and most regulators are aware of the size of the debt, and that the housing prices are relative to other countries is extremely high, and that there's this danger that if the whole thing falls over, you could have this financial crisis. And the sad thing is it can turn some people into sort of bubble managers in terms of what the whole thing's about. Let's just not let this fall over on my watch. And what can I possibly do to keep this whole thing going so the whole thing doesn't fall over on my watch? Which generally speaking, when you've got a problem, trying to sweep it under the carpet and wait until later generally just makes the problem bigger and the final washout worse. But that would sort of lend again to that view that, look, the harsh words will be spoken, and there'll be lots of this should never have happened, and we'll make sure it never happens again. But quite possibly, when push comes to shove, the steps they're going to take won't be harsh enough.
So I guess on that note, and looking, I guess with the investment lens on, then is there perhaps an opportunity there where the market will overstate the potential impacts on, say, bank share prices, and then obviously with the position that it might not be ultimately as bad, come what may, and probably needs to be worse, but it might not end up being as impactful on the bank's bottom lines. Do you think there could be an investment opportunity in the
going along the banks?
Mega bank.
Look, we're not taking it at the moment. I think we'll see what comes out of this interim set. I also think the rhetoric will ratchet up over the next until the election, basically. So what have we got? 6-9 months, depending upon when it gets called. But I'm expecting that the rhetoric will get ratcheted up, and if you're looking for that opportunity, there'll be a time somewhere in there. The question though as well is, has the snowball of the housing prices falling? Does that grow into something larger? It's as we spoke in that, with during the last little bit, it's hard to see a case globally where you've seen a housing price crash that hasn't been preceded by interest rate rises. But the question is what we're seeing enough to, in terms of is the pullback in lending enough to sort of trigger the houses to fall over on their own? And so, there's certainly some downside risk that we're not discounting. And so, if you had the view that it will be a slap on the wrist, then I think you'll get a better buying opportunity sometime in the next 6 to 9 months than right now.
Okay, yeah, sure. All right, very good.
So I guess in summary is, we're underweight the banks. We've got a degree of negativity to it. There's a relatively big downside risk, but the probability of that happening in the next 6 to 9 months isn't huge. It's meaningful, but it's not huge.
And so for me, it's trying to weigh up the price. If the prices were 20, 30% lower, they'd be a lot more attractive. If they were 20, 30% higher, we'd be at minimum weight at the banks. Where they are at the moment, we're certainly underweight, but we're not selling more at the moment, and monitoring situations.
Nucleus Wealth and the Macro Business Fund was put together to help give you access to quality, well-researched stock analysis and superior macroeconomically minded asset allocation. We use technology to help us provide a service typically only available to high net worth and sophisticated investors at a fee level that rivals the more basic solutions available to these everyday investors. We do this by using separately managed accounts, which allows clients to enjoy unparalleled transparency in what they own and why. It also means that each client effectively owns their own separate and discrete share portfolio, which is managed by us. We have partnered with Linear Asset Management, who are backed by the ANZ Bank for cash management, and JP Morgan, one of the biggest banks in the world, as custodian of your assets. We feel that this structure is the gold standard for your financial protection. In addition to this, we offer 19 separate and individual ethical screens that you can use to help tailor your investment. To ensure that your money is not being used to support companies that deal in areas and practices that you feel are important. By eliminating the areas that are only important to you, you keep the potential for higher returning areas that you might otherwise be ambivalent about, and these would typically be ruled out in broader ethical products currently available in the market. The name Nucleus comes from our ability to provide the core holdings of a client's portfolio, allowing them the time to explore areas that may be of interest or they may have experience in. We also offer a complete investment solution for those who don't have time to coordinate their own investments. Our investment team has decades of experience in world markets, and we have access to a global team of stock analysts. By removing the layers of middlemen that typically sit between your money and the markets, we've been able to reduce fees and provide unparalleled transparency in the solution we provide. For more information on what we can do for you, please call 1300 623 863 or contact us through www.nucleuswealth.com.